The Iran war and the closure of the Strait of Hormuz has jolted the global energy markets, and now there's further uncertainty as the UAE has announced its plans to exit OPEC. Joining us now to discuss what this all means for the price of oil is Bart Melek, Head of Commodity Strategy with TD Securities. Bart, great to have you on the show again.
Well, thank you very much for having me.
As you know, lots happening in the news. We'll start with the news of UAE planning to exit OPEC next month. What sort of impact could that have?
I think in the short run, not very much. Typically the issue with OPEC has been to keep supply under wraps, in essence, make sure there isn't rampant overproduction and discipline along a quota system. But given the Gulf War right now, we're seeing some 8 million barrel per day deficit. We're quite sure there are a few million barrels of supply that has been destroyed due to the conflict. All these producers in OPEC, Saudi Arabia, and even when United Arab Emirates is out, they will have to produce at full speed, and that's probably not going to change for at least a year and a half to 2 years. So the immediate impact is not significant. Everyone is going to try to produce as much as they possibly can, and we're not going to worry about adhering to any quota or being retaliated against by Saudi Arabia if you overproduce. And they happen to have some million barrels of more capacity than their quota, and they want to deploy that clearly. Okay,
now, of course, the Strait of Hormuz remains closed. What sort of scenarios do you see potentially playing out here for the energy sector?
Well, it's getting a little late in the day for things to be left benign. And what do I mean by this? Even if the war stops today and tanker traffic moves through that choke point, it's going to take a few months for tankers to go from the Straits of Hormuz, the Middle East there, to some Asian destinations. And we are noticing a pretty severe decline in the amount of oil at sea available to be distributed to consumers. And I suspect that in the next 2-3 weeks, we are going to start hitting some hard physical constraints, and we could still see significantly higher prices. If this thing continues longer than that, it could be even more severe. So we could, theoretically, without any difficulty, see $150 Brent.
Okay, now, it's not just oil that's been impacted by the closure of the Strait of Hormuz. What other parts of the commodity market are also being impacted?
Well, I recently wrote a piece on fertilizers and food inflation. And fertilizers, they are not necessarily talked about a lot, but they are an incredibly important factor of production for agriculture. And the Middle East produces a lot of ammonia, urea, LNG, which fertilizer producers take the nitrogen out to include in fertilizers, sulfur, and other additives that are used as nutrients for farmers. And that also ultimately means that with prices sky high and de facto shortages, that we will see less intensive use of fertilizers, meaning that crop yields next season, upon harvest, may be less than they were in previous years, and that could very well mean higher food prices. Diesel is extremely important for farming, and not only transporting, but also drying and processing. We are seeing stories anecdotally at this point. Statistics are hard to get that some farmers across the world, in Australia, to mention one destination, where they're not planting for the lack of diesel. We're seeing fishing fleets around the world not deploying their fleets to gather seafood and fish, which means you will need to rely on protein from other sources, which tend to feed on grain. And so you could have that cascading effect.
We're seeing that wider effect
on food prices, I think.
Now, it's not just food, but gold has been on a bit of a roller coaster recently. They've pulled back from highs. What's happening in the precious metal sector for the precious metal, actually?
Well, precious metals have suffered because of this war, and it's contrary to what most people would automatically assume. And the reason is you associate gold with inflation, and the argument goes, if inflation is high, gold will tend to do well. And that is very, very true. Now, the trick is, in order for that to happen, you're going to have monetary authorities that sort of ignore inflation. So typically, if inflation is running at 2.5%, a little higher, central banks aren't particularly worried, and they might want to keep growth strong. And the argument is, well, what's 1%? No big deal. And interest rates could very well be accommodative and negative in real terms. And that concern has propagated this whole debasement trade. But now the fear is that it's not going to be 2.5%. It could very well be 4% plus. If we have an additional oil shock, an energy price shock, it could be higher still. When in those circumstances, central banks probably have learned a lesson from late 70s, early 80s, and might want to be restrictive, meaning real interest rates quite high, and meaning that gold will likely have a difficult time because carry costs and opportunity costs are high relative to the fixed income market. And it always is the case that really, in the end, gold is a function of interest rates. When central banks are irresponsible and allow inflation to fester, gold does well. But when they tighten up, as we know, after Mr. Volcker took over, we had high inflation and gold collapsed after a while. Then, at least for now, we think we could see a correction. Same with silver, but silver has an additional problem. It's an industrial metal as well, 60% of it. And if we get any sort of form of stagflation, a weak economy, meaning that silver demand for industrial uses, everything from catalysts to chemical industry, even jewelry. People who don't have jobs don't tend to buy a lot of jewelry, and that could weigh on silver as well. Longer term, we're very, very optimistic on both, but I think the trick is going to be to keep the faith over the next few months.